We all pay for insurance, right? For our cars, our homes, our health. But have you ever really stopped to think about how that business actually works? It turns out it's a fascinating financial machine, and it operates unlike almost anything else. So in this explainer, we're going to pull back the curtain and look at the hidden mechanics of the insurance industry.
You know, life is unpredictable. That's just the reality of it. I love this quote from W. Somerset Maugham. There is very little about which one can be certain. Accidents happen, disasters strike. We just never know what's around the corner. And really, insurance is our collective answer to that fundamental uncertainty.
So at its heart, the core promise of insurance is actually pretty simple. It's designed to make the unpredictable manageable. It works by taking small, regular payments, what we call premiums, from a whole lot of people. All that money gets pooled together into one giant pot, which is then used to cover the huge, unexpected losses that will inevitably happen to a few people in that group. It's basically a giant system for sharing risk.
Now, here's what makes the insurance business so unique. Think about a manufacturer. They get paid after they build and sell a product. A bank? They get paid back over time for lending out money. But an insurance company? Well, they get paid up front for selling a promise. A promise that they'll cover some future costs that might not even happen for years or maybe ever. Getting paid before you have to deliver is the absolute key to this entire model. This core idea is called risk pooling. And honestly, it's the magic that makes the whole system work. By spreading out the financial danger of some huge event across millions of people, the cost for any one person becomes totally affordable. Your $100 premium, when you combine it with millions of others, is what can cover someone's $1 million loss from a house fire. Okay. So if it's all about pooling money and paying out claims, how do these companies actually turn a profit? This brings us to the real secret of the industry. You see, insurance isn't just one business. It's actually two completely different profit engines working in perfect sync.
The first engine is the one we're all pretty familiar with. It's called underwriting. This is the classic insurance business, right? You've got actuaries and underwriters whose job is to figure out risk. How likely are you to get into a car accident? What's the chance of your basement flooding? And then they set your premium based on that risk. Now, in a perfect world, they'd collect way more in premiums than they ever pay out in claims. But it's definitely not a perfect world.
Take a look at this number. This represents something called a combined ratio, and it's a super important metric in the industry. What it means is that for every single dollar the company collected in premiums, it actually paid out about $1.08 in claims and other expenses. So, on their main business, they were actually losing money.
Which, of course, leads to the big question, right? If your main business is consistently losing money, paying out more than it brings in, how on earth do you stay afloat? I mean, it seems like a recipe for disaster.
And here is the answer. It's pretty wild. In a typical year, the U.S. insurance industry lost almost $21 billion on underwriting. Ouch. But then, look at that second bar. They made over $31 billion from investment income. That profit from investing didn't just wipe out their underwriting loss. It left them with a total profit of over $10 billion.
And that right there is the second engine. That giant pool of money from all our premiums, what people in the industry call the float. It doesn't just sit in a checking account collecting dust. No way. The insurance company takes that money and invests it in stocks, in bonds, in real estate, you name it. And the money they make from those investments is often so huge that they can lose money on the insurance side and still be massively profitable.
But not all insurance is the same. The way they invest that float really depends on the kind of insurance we're talking about. The industry is basically split into two big worlds. You've got life insurance, and then you've got property and casualty, or P&C. That's the stuff that covers our homes and cars. And the kinds of risks they cover totally changes their whole game plan.
The key difference between them boils down to this one concept called the tail. The tail is just the amount of time that passes between when you pay your premium and when the insurance company actually has to pay out a claim on that policy. And, as you can probably guess, a longer tail is an investor's absolute best friend.
So, for instance, a homeowner's policy is what they call short tail. If your house burns down, that claim gets paid out relatively quickly. So for that kind of insurance, getting the underwriting right is absolutely crucial. But then you have something like a general liability policy, which can be long tail. A claim made today might not get fully settled for 20 years. That's 2 decades for the company to invest that premium money, which means they can afford to lose a little on the underwriting side. Now, this powerful two-engine business model doesn't exist in a vacuum. It's always being pushed and pulled by outside forces. To really get a sense of this, let's kind of jump in a time machine And look at a snapshot from around the year 2001 to understand the huge trends that were transforming the entire industry.
Regulation has always been a huge deal here. For more than 100 years in the U.S., insurance was mostly handled at the state level. But then in 1999, a massive change happened. A law called the Gramm-Leach-Bliley Act came along and basically tore down the old walls that separated banking, investments, and insurance. This is what allowed these separate financial worlds to start merging into the giant financial service companies we know today.
So back then, you had four major forces all hitting at once. Globalization was pushing insurers into brand new markets. Convergence, thanks to that new law, was blurring all the lines between different financial services. Companies were transforming themselves to be more specialized and efficient. And of course, the internet was just starting to completely change how we all buy and manage insurance.
Okay, so after all that, what does any of this mean for you, the person just trying to pay their monthly premium? How does understanding this whole complex system change how we think about it?
Well, here's the big takeaway. That premium you pay isn't just sitting in a pile waiting for you to have an accident. It's an active, working part of the global economy. Think of it as your entry ticket into a massive financial engine that is doing two things at once. It's protecting millions of people from risk, while at the same time, it's funding companies, building infrastructure, and fueling innovation through its giant investment portfolio.
And that leaves us with a final question to chew on. When you make that payment every month, are you just buying a safety net? Or are you, maybe without even realizing it, also making an investment, contributing your small piece to one of the biggest and most powerful financial machines on the planet? It definitely changes how you look at that bill, doesn't it?